Tech stocks are sliding and traders are suddenly rethinking their entire bull case. If you weren't watching closely, you probably missed the moment everything shifted. We got it covered. Let's break it down. Real quick, 27.5% of you that watch these videos do not subscribe. If you trade or invest and want to stay ahead of moves like this, hit subscribe, turn on the button because these videos come out at different times. Let's get to it. We have a lot to go over between smart money, dumb money, what we're seeing with the highs of the market, the rotation that's going on. I find the most fascinating thing going on right now, U.S. Steel. We're going to spend some detail on that and how it can affect policy big time. It's actually one of my biggest concerns is that U.S. Steel deal. But we'll get to that. Here we have Itchy special level. This is where he cut interest rates, couldn't explain why, and we've been struggling with that ever since, trying to get over. I do think this is very important in the way that you're acting. You have rallied to this level and you have gotten completely matumboed yet once again. And this is, for whatever reason, is becoming our nemesis. There are some things here that are very, as I like to say, absolutely glaring. And we're just going to go through the basics before we go any further. If we take a look at the RSI here, and we can see very, very clearly how that RSI has peaked, rolling over here. I don't usually use I don't really like the line, but I put it in for people who use this demarcation. I'd rather look at this on a 4-hour, candidly. And what you're going to see is that, yeah, you're already oversold, but you're not really seeing any signs of it ending yet. You're seeing that rounding right here. And we've been talking about this positive divergence that's been going on for some time. And then we talked about when it flipped to a negative. And you can see this here. And we go through these in the pre-market videos that are public every single morning that start at 8:15, 8:30. Even if you can't make them, just watch them before the market opens. We go through some key things. People that watch those knew clearly what was going to happen Monday, or rather Wednesday at 1 o'clock with the bond market, the 20-year. We went over it in great detail. So if you watch these levels in here and you can see that, has this negated? Has it come down enough? The answer is yeah, you're down here and you're oversold now. Does that mean you have to bounce? No, you don't have to bounce. You can stay down here for a very long period of time and just go sideways and just continue the bloodletting. And there are things here that are telling you that this was kind of telegraphed. If we look at our trend from here, I don't use the wicks, I use the bodies. And you can see that you're kind of running right into that. You can actually even use the shorter one right here, and you'll see it even clearer, more clearer. Some people would say it's glaringly obvious what happened right here. But what are we getting from this and where do we go? Well, we would drop it down to the hourly for a second, and we're going to clean all this off. And then we're going to note the undercut and drop that happened on Friday at 6 o'clock, and that you never really had to worry about it since then. But you should be able to see this line, and it ties directly in. So here's that low, here's the break and the retest. What I see here on the hourly chart is a pretty clear pattern, and we're going to get rid of all that for a second and just talk about it. What I have here is I have a left shoulder, a head, and a right shoulder. People say, well, it's not really there. It doesn't have to be exact, but we have to pay attention to it, and we have to pay attention to the neckline. What's crazy about this neckline is that we can actually say that it's more of an area than an exact number, but we're going to get into this. Now, we all know what happened Wednesday at 1 o'clock, and we can all see it marked right in here. Obviously, when the bond market decided to act on that news, which was a pretty much dumpster fire, it's very, very hard to miss. Okay, so we have the meltdown. We come across, we retest this level. We bounce back off of it, and we really can't get anywhere here at all. And we can see these levels pretty clearly. Like you're not getting anywhere that you really want to get to. And I'm just going to mark them off. And you see like the tests and the Matumbos. What bothers me too is they're fast. You're hitting, and then they're just quitting. Like it's not a trickle. It's, oh no, get me out. And we're watching these levels fail time and time again. What else you're probably noticing about your long-term trades that you're putting on, or your swing trades, after you're entering your swing trades, you'll noticing that very rarely are they going back to those levels. That's another telltale sign that we're having some issues here. So once we look at this stuff, it's getting to me pretty clear like, hey, yeah, we can look at the RSI and see that, yep, we're all over the place. And then we can go out further again and go, yep, I get it, the RSI, and now we're down here, but we're bonking around. But you're getting to these levels that you're not able to get back over. You're developing more of a stair step down than you were previously, and we're breaking some key trend lines. I would not sleep on this, especially going into next week with NVIDIA's earnings, which we're about to cover in a little bit here, and then AVGO as well. To me, this is critical and things that we should be paying attention to. If we go and take a look at the breadth of the market, let's find that sucker real quick and do it this way. If we go and take a look at the breadth of the market, and this is just the S&P, 250.25, 250.25, percentages above and below. What I don't really like, which does not make me feel warm and fuzzy, and I felt warm and fuzzy before and I like it, I like when I'm above 50 on the 200. I no longer am. I lost it. I'm at 45 now. Now, is this the end of the world? No. But it's better when I'm above it than when I'm below it. So this means 55% of all stocks in the S&P now are below where they once were, which was up here, which was 55, which was warm and fuzzy level. We're not there. And now we have the 50 that is still over, even though the 200's not, which becomes a problem. Because if the 200's breaking, then the 50s are going to break, which means that you have more downside. I'm not crazy about how this is set up. This is an issue for us. This needs to right itself. It's pretty rare to get over 55 and then lose 20% of those names in 3 or 4 days. It just is. So, and that's what you've done, 55 to 45, 10, just do the math. But if you look here, 78% to 59, I'm not really that worried about that. The 20 losing 50, I don't care as much. But here I really do care about that, and it does bother me. I think that you're setting up for some kind of bounce because you're back to single digits on the 5-day. And if you ever look at the 5-day, you get a bounce. What we look for on these bounces is where are we in regards to everything else. And I don't know how strong that bounce is going to be here. Now, going into the weekend, Memorial Day weekend, we have to watch. It could be pretty strong next week. We just don't know that yet. I think the most important thing for us to do is start looking at where all the players are, like smart money, dumb money, for example. Start understanding where their heads are. Start looking at stocks that are above their percentage on the highs and percentage of lows. I think that's extremely helpful. But I think we'd be remiss in not pointing out some details here. First and foremost, we're back over 50. So 450, 451, we don't want to be there, that's for sure. The dollar came in. We're back under that 100 level. We don't want to be there. So this is a weight on us. And I don't think that, the tariff on, tariff off was the best thing in the world. So I do think that people are getting a little skittish here, and we do not want to break that 100, and we did. And I think it's more of an issue than people think. And what it did was it ran us right back into the gold trade. And you can see how the gold trade's going. Here we back are at 308. And we've been back in there since that Monday, and you've just ripped and dipped. I don't know that I have to get crazy involved here, but again, I think I'd be remiss before we get into smart money, dumb money here, just not showing the Captain Obvious stuff. Like, here's my DTL, and I broke it. And usually, and I know people are like, it's not a leading indicator. It's a leading indicator to me. If I'm breaking a DTL here, chances are I'm going to break this DTL, which means to me that this could be lifting. Now, if I have a trend there, I like to clone these and just drop it down and see if there's a trending corresponding level. And there is right in here. You can see that corresponding level. So we have the same trajectory. It's important that when you look for these columns, or areas or channels, you have the same trajectory. You do. You're at the top end of it. Now, if this rolls over, you might say, well, we're at the top end and we're going to come back to the low end. I would argue that this is kind of setting up for a possible breakout. And the physicality of things is becoming more of interest here. Let me show you what I mean by that. So this is core commodities, and we can see core commodities are kind of hanging in here, right? All of a sudden, they're starting to gain a little bit of interest again. If we take a look at copper very quickly and say, okay, well, what's copper doing? Well, copper's going higher again. So all of a sudden, all these things that were starting to come in and go sideways, well, they're not doing that anymore. They're starting to rally a little bit. Here's lumber, again, starting to turn up. This means that they are buying physical assets. And now you can go take a look at crude oil as well. That's kind of selling back down. Now, why is that? Well, there's going to be a myriad of reasons for that with Iran and everything else that's going on. What I would argue about that, in my opinion, is does that mean that they're expecting a slowdown again? There's a lot of nuance to this. And how I feel about it is this. I don't feel that tariffs should have taken us here. Obviously, I don't feel that way because we bought in here if you've been watching these videos and they're linked. I'm not sure that we're here and everything's hunky-dory. That's kind of where I'm at right now. So the question is, where does that equilibrium take place? I mean, does everyone really feel that things are that great? I think the earnings front, yeah, but I think there's a level of uncertainty with the tariffs in the market and some of the instability, and I don't know that we're looking at that the right way. That's where my head is. I'm always interested in your comments on this because there could be things that I'm missing. And we can get into car loans in another video and how they're ticking up for people. But let's get into the smart money, dumb money here. Some technical graphs here I really want to go through, and I think they'll be very helpful to explain what's going on out there and how I see the world and going forward. So you have to realize that you have several different views. And by several different views, you have to pick your time frame. In other words, as a trader, I always break this down into quadrants, and maybe I should break this down into quadrants so that you guys know where I'm going with it. Because I'll say like, oh yeah, I think that we're bottoming, and then we drop on a Tuesday, and then someone says, "Ooh, we dropped on a Tuesday," and you said we were going higher. That's what you guys sound like. Here, let me break this down real quick and how I see the world. So I see the world as 5 different stages of trading acumen, and meaning like levels of professionalism on where you're at. There's 5 stages to each, but inside each of those, there's quadrants. And I'll explain how I view the quadrant. So you have a day trading quadrant, you have a swing trading quadrant, and you have a long-term quadrant, and you have special situations. Special situations, US Steel, a biotech getting bought, something trading at book value that you think is cheap, et cetera, et cetera. So then out of those four quadrants, you have a way of looking at this where you divide it by 8. And you divide it by 8 because you also have to deal with this is the underlying asset and this could be the derivative of the asset. Meaning you're buying a stock, for example, for a day trade, or you're buying an option. An option is a derivative. And obviously you have at least 6 different variables when buying an option than you have when buying a stock. So the variables increase. So when people trade stock and then they think they can trade options, it's very different, right? And it's no different than when you're here and you're swing trading a stock and then you're long. Like if you buy the Qs here and then you buy the TQQs here, it's a completely different trade because you have that decay and how it's calculated. People don't realize that. And then in that, you have 5 stages. And I can do a longer video on this, but it's important to get this. Because what will happen is this is where people really screw up. You have that first stage, even if you make money, right? You have that stage, which lack of a better term is, I suck, I just don't even know why I'm bad. And then you start getting to that, oh, I understand why I'm bad and I know I could make changes. And then, believe it or not, that's not where people quit. This is where they start to quit when they go sideways because, quote, it's fixed. You know what you're supposed to do and you're starting to do it. And 4 is also where people quit because they're like, oh, it's not worth it. I'm not making enough money. 5 is really where they want to get to. Just because you're good at swing trading and you're good at swing trading stocks, people think that they can day trade. You might be a 4 in swing trading and you might be a 3 in options on day trades and you might be a 1 over here in special situations. The purpose of me breaking this down is before we get into what we're going to get into, please understand, and I can do a longer video on the 5 stages, but you have to understand as a trader or as an investor, which quadrant are you in? Because if you're a swing trader, you're a swing trader. If you're long-term, 3 to 12 months, then that's what you are. If you're day trading, then that's what you are. So when you look at the data that's presented, you have to look at it through your lens and how that data is going to affect your trading. All right, let's get back. So that said, when I look at something like the SPY new high list on a percentage basis, I'm looking for past performance to tell me what's going to happen going forward. And it doesn't always work that way. Now, for my purposes, I always cut out this data from Jan on because everybody want to say it with me. The Fed injected what? 1.7 trillion in the market. We were calling JPEGs NFTs and we were really, really cool. What you'll see here in red is you'll see these huge spikes. That's your percentage of new lows and the new highs are in blue. I put them all in together so that you can see it. What you will notice with any good bottom or top is you will notice a divergence. That is a positive divergence where you took out the low, even though the new lows weren't there. and you can kind of see how you are. Well, that's really poorly drawn. Where you're right here. And point being is, even though we took out the new low, it was not here. And this is really what I refer to as a hidden positive divergence, because you'll assume that it's commensurate because it's down, but the trajectory is very different here. I'm going to do an advanced RSI video because I got asked to, so I will be doing those. Very similar to what you got here, where you've gotten this negative divergence from up in here, and you can see that that actually led eventually to us selling down. What I think is super important about this graph of percentage of new highs and new lows over 5 years, and we're going to drill into this in a moment, is that this peak in regards to this peak, and we can even go here. When you're getting to that level of percentage of stocks at new lows over the past 5 years, it's put in a bottom. Can you double tap the bottom? Yeah, you can. It'd actually be great if you do, because it would present people that are in that third category, the long-term category, the opportunity to buy names down. But can it get back down here and retest? Yes, this does not mean that you can't retest, but what it would do is it would present opportunity, in my opinion. I don't think that you're going to crack this unless we go into straight out recession. But if we just take another quick moment and we look at this on the one, again, I'm sorry, let's do the three and then we'll do the one. And you can see again, these are this is pretty obvious, like things that are completely obvious, right? You can see how you're going higher, but you're not hitting new highs. You can see how that low is put in here over our threshold, and that has determined that bottom. Remember, the red is the lows and the blue is the highs. And you can see that here as well. And you can see again that divergence that I'm talking about. And to me, it's what I refer to as a hidden positive divergence. I am going to do that video. I got a lot of requests for it. And if I get a lot of requests and comments, it just tells me like, hey, yeah, I really care about that, so I'll do it. But what are we saying here? That's a bottom, man. There's some other charts I'm going to show you in a little bit. And it does mean I do think that there's a chance that we do a little bit of backfilling, but that's pretty healthy. Do I care about where the new highs are right now? Not overly. I don't know that I really care about where the new highs are here. I mean, did we really hit new highs? Are we at that point where we would expect to hit new highs? Not overly. I was looking at this in the convergence down here and seeing if there's nuance to it from when we flip from red to blue. I think there's a convergence from flipping from new lows to new highs, and I think there could be something to that. I think I'm stretching. I think I'm looking for something that might be there, maybe not, because you can see that the red and the blue flipping down in this area, and you can kind of see it here as well. But I think I'm really stretching to find something there. Whereas what works best is consistent new highs, right, over a period of time. And we could be building that. We could be building those kinds of periods. And that's what we want to look for. Does this build? Do we consistently hit those new high percentages? This is the S&P new high percentages, not NYSE. We're going to get to that in a while here. We're going to look at McClellan and dig into that. And we're going to look at the ADL as well. But I think if we look at this, what should we really take from this data? And I get asked this a lot, like, okay, Rocky, just get to the point. Your new lows. You're sitting here, that's a bottom. Unless he goes, full tariff, and you never go full tariff. So let's see what happens. Now, in front of us is smart money, dumb money, the confidence spread. And I'm going to do this one backwards because I'm more interested in the spread because of what I'm saying. Smart money, we don't call it that here. We call it institutional. Dumb money, we don't call it that. We call it retail. Why? Because that's how it's calculated. Smart money is calculated by institutional order flow, and dumb money is calculated by what? Retail order flow. All right, I know guys that watch these videos, like my God, he says this all the time when he does it, but you know what? We get a lot of new people here. So Sentiment Trader, that's whose graphs these are. I have spoken to them before, and they are fine with me showing these graphs. They don't have a problem with it. This is 3 years, and that is pertinent. What I want to point out is this bottoming here. When you're bottoming in these areas, I always want to pay attention to it because you can stay here for a while and just balance out. Remember, smart money moves like a tortoise because it's institutional. Dumb money moves like a cat in a hot tin roof because it's scared. Its weakness sickens me. So when you get to these levels, you look for inflection points. Those inflection points and breaking these key levels on it usually tend to mark bottoms. When you get to this green, it usually tends to mark a bottom. When you get to this green and you roll over, it tends to mark a bottom. If you get to this green and it rolls over, it tends to mark a bottom. All right. So I can't be any clearer. You should be able to see that over and over again. My concern is that when you get to the red and you flip the red, it can mark a top. So if I come from here and I draw this over and we just go straight up, you'll see that's a top. If I mark when we flipped over here, you'll see as well, that's a top. And it's over and over and over again. So this is why I spent time doing the quadrants before we went further with this, because I want people to understand, because something long-term on one side with the new lows is saying bottom. Order flow here, breaking below it is fine. Breaking above it and going above it as it goes forward becomes the issue. Why would this go forward? It would go forward because smart money is either selling or not buying as fast as dumb money, retail, is selling. Okay? When retail wants to sell, institutions just go, just sell. Go ahead, do it, because they want to buy it. I'm not trying to make you laugh, but that's really, they're not our friends, right? They want us to sell in a panic so they can profit off our fear. I mean, it is what it is, guys. You're playing against the smartest, most disciplined people in the world. Now, when we get into this on the 1 year, you can see it even clearer. Hopefully, you can see this clearer. But you flip, and what happens? Boom. Matumbo, straight up here, right? You can't break. What happened here? I'm glad you asked. Same thing. And this is just over 12 months. What happens when you hit green and rolled over? When you hit green and roll over, say it with me, it's a bottom. When you hit green and roll over, what is it? It's a bottom. Say it with me. All right. Even if you hit this and then go higher, you can see the peak. I mean, someone could even say it's glaringly obvious for the men and women who make their decisions based on the three-legged stool. Life becomes glaringly obvious. So what's this telling us? Short term, we might have a problem. We might be heading back to this level, and that becomes an issue. Smart money, dumb money confidence, when we flip to this and we look at this over a 3-year period, which I think is pretty important for us to do here, it's going to tell us something. And what is that telling us right now? And I think that this is worth our time to get into. It's telling us a very key thing. Well, institutions are selling now, right? They got their bellies full up here when we were all panicking. What are they doing? They're feeding off our fear, right? I mean, that's just what they do. The flip's not ideal when you cross here. Blue crossing red to the downside is not great. It's not what you want to see. It just isn't. If retail gets into one of their little hissy fits and starts selling here, we're going to have a problem. And I'm thinking that you're going to wind up coming in here a little bit. Usually, AVGO marks the top. And I'm going to get into some of that later if we have time in this video. But AVGO usually marks the top in tech. I think their earnings are June 2nd. But I do want to go through the ADL and the MAC McClellan summation as well. So we'll have to see how much. As you can tell, these are done off the cuff, and I just rock and roll with them. I do pull pieces out and go through other pieces if something changes like we did or will do with U.S. Steel. Now, but if I look at this, what's it telling me? Retail's starting to sell. We have to pay attention. If we take a look here on the 1 year, pretty obvious what's going on. Once again, retail is selling right in here, and you just blow it up. And I like to take a look at the 3, the 1, and then you can kind of overlay this and go, okay, does it make a difference? Yeah, it makes a difference when you're this full. It totally makes a difference when you're this full. And you have a lot baked into the market right now. And here we are just year to date, and you can see the cross here. And we have broken this for the first time. This is the first time that we have broken this since this started. And I think that that's very important to realize that year to date, you have not gone over this and broken to the other side of it. And that to me is like, hey, you might want to be a little cautious here. The nice thing about sentiment traders, I can actually break out dumb money confidence by itself. And you can see in 3 years, just dumb money confidence or retail by itself is over and rejected. And then you can kind of look at where they are and see them. For me, it's more about the relationship to where retail is in regards to where institutional money is. But you're at this 0.7 level and you're at this 0.3 level down here, which is a buy, and 0.7 tends to be a sell, but it depends on the relationship on where you are. Interestingly enough, and I'm interested in comments on this because people say they listen to this, Spotify reached out to me and wants me to do this as a podcast. I don't know how much value it would have as a podcast being audio only, but they asked me to do it. And I don't know, I'm interested in your guys' comments on that, what you guys think, if it makes sense to put this on Spotify. Now, in regards to smart money confidence, you can just see very clearly that you're up over and you broke 0.7 to 0.4, and you can see how that's going. Also, I really appreciate the sharing and the subscriptions last time. Seriously, it makes a huge difference. People always say to me, how's this channel not bigger? It's because I don't put ads in the middle here. So what I make up for, what the deal is with you guys, is if you share, subscribe, it makes my life easier. The notifications, all of it makes my life super easy. Because I try to pack Saturdays in, because that way you have the time to digest the information. So I appreciate you doing that. I want to go through this study. I found this study absolutely fascinating and I wanted to share it. NASDAQ Composite, after it closed above its 10-day average for 21 straight sessions following a 6-month low. All right, so let's go through this. I make a 6-month low, okay? And then after I make that 6-month low, I get above the 10-day moving average. Let's call that the 10-day moving average. Yay. And I stay above that for 21 sessions, right? Over and over again, 21 times. Yay. What does that tell me going back from 73 over? And this, to me, like, I love stuff like this because it's real data and it's real statistical edge. See, anytime that you get 30 or more data points, you have statistical edge. You need 30 data points. You got enough here. So they say it's 26, we'll take what we can get, but you want 30. And what they're gonna show you, because I wanna break it down for you, is where are we a month later? Where are you 2 months later, 3 months, 4 months, 5 months, 6 months, and 12 months? And it breaks it down line by line on what happened. Now, in the 70s, you got whacked, completely shellacked. In 87, you got whacked 12 months later. There's only 2 times 12 months later after this happened where the market's down. There's only 2 times in 12 months when this happened that the market's down. And that's, that can happen. And that's an issue. So like if I circle this, are you willing to play those odds? If I had to flip a coin, would I play those odds? Yeah, I would. I've been saying that we're in the 90s for a very long period of time. And I'll just circle that whole sector from like 90s on. Like this is where I think we are. I'll get into it in another video because we don't have the time. I think that that's what we're setting up for here because I think we're going to have increased productivity and they're going to have to cut rates. And I think that's because of AI. And I think there's reasons for that. But nevertheless, this has always been kind of that area where I say that we're in and we'll go from there. But please look at the data here and please look where you are 12 months later. And these are not small numbers. Like if you look at what the average 12-month is normally versus what these numbers are, they're killing it when you get this indicator. And here's the thing about it. If you don't know what the Z-score is, you can look it up. I've gone through it a couple times. I'm gonna make it super simple. If you see a Z-score, think standard deviation. 1 standard deviation is 67%, right? 2 standard deviations is 95%. 3 is 99.7. That means, is there statistical edge to it? That's how, just think about it that way. It'll make your life so much easier. So when someone says, I ran this study 400 times and I got XYZ, your first words out of your mouth are, what's the Z-score? And when they go, what? Just go, loser. Because that means they don't know what they're doing. If you can't look at the Z-score and drill into it, you don't have anything. So it's telling you the beginning of what we just went over, what's going to happen, what the Z-score is for what happens here. When you get into the middle time frame, there's no statistical significance with this whatsoever. Remember where we just were, just so you get it. 2 months, 3 months, 4 months, right? So you would go 3, 4 statistical significance, right? So you're going 3, 4, there's no real statistical significance here in the middle of that. But that's the devil's with this stuff's always in the details. So then you're going, okay, well, what about the 6 to 12 month? Is there any statistical significance? And what's cool about it is it actually gets stronger. When you start saying 92% of the time, the median average is 22%, you have statistical significance of 2.2, you want to pay attention to this. It's really important. They even tell you right here, Z-score plus, minus 2 suggests significance. I want you to think of it as standard deviation because I think that's easier for you guys to wrap your mind around when you think about Bollinger Bands, etc. Then they break it down with what sectors do the best. And you would think, because there we go again, thinking, you're like, oh, it's going to be tech, boomer. Not so fast. Consumer discretionary. Consumer discretionary 12 months later is leading the XLY name. So now we have this opportunity where all these XLY names are beaten down. And now you not only want to look at it, what's winning. I'm not saying that it's not financials and you shouldn't look at financials or you shouldn't look at tech. That's not what I'm saying. What I'm saying is if someone had to say to you, who is the clear winner whenever this happens, it's consumer discretionary. I could spend a lot of time dragging these studies out, guys. I'd just rather pack it all in and then you can go back through it. 12 months later, what happens? 92% of the time you're up. Which one of these tends to lead? This is where it gets really, really, to me, really cool. Once that triggers, which it just did, what's the first to go? A month later. So the very first thing they do for the first 30 days is they start buying energy names. Kind of interesting if you go look at the XLE right now. If you go and take a look at that, pretty interesting stuff. I was kind of surprised by this myself. But as you go through it, you'll start seeing there's nothing here where we talked about that 3-4 level. Then you start getting into that 5. You're like, okay, well, there's some significance here with the industrials. I say it. But the industrials actually get stronger after 5 months. Like there's a higher degree of probability that industrials will actually get stronger as this goes along. There's significance in that. And there's also significance here in looking at consumer discretionary and how that moves along. Also take a look at information technology 5 to a year later. So what is this telling you? What would you do with this? Short term, yeah, you probably get a kick on this And you might have seen a partial kick of that already, but we should be focusing on what energy does probably over the next 30 days. Longer term, 5 months in, 6 months in, start getting into that October kind of time frame. It might be on like Donkey Kong with some of these things that the industrials, the tech, the consumer discretionary, right into that, end of third quarter, fourth quarter season. If you like this kind of stuff, just comment on it. Lets me know to keep rocking and rolling. I don't want to spend 15 minutes on a study when I can spend 5. Now, there's a lot covered in there, and you might want to watch a couple pieces of that again. But more importantly, where I'm going with this is everything else safe? And the answer is no. A lot of people were chasing the DAX again, and EU AD was a really big trade for us in the community. And if you're on the wait list to get in, check your email this weekend because a small batch of invites is going out. But if you're trying to get on the wait list, the link in description, and then I'll pin it in the comments. But here's the thing about it. Like, I don't feel the need that I have to chase anything here. We're really ahead of ourselves yet again. And then everyone thinks everything's fine. And then here he comes, Mr. 50% tariffs. And now the tariff game, and I understand the reasoning for doing this, but just look at this headline for a second. I think there's some odds and ends we need to go over here. Trump's new threat of 50% tariffs on EU goods. A lot of this is going to sound like I'm negative on what's going on, and I understand that with today, but you can't keep going backwards. It's not going to work. It's going to create more division. Trump threatens once again Friday, we're going to ramp up our trade war on European goods. The reason for doing this, frankly, is because he's watching China pass goods through the EU and then the EU pass goods on to the US. It would have been better if he explained it that way. That probably would have been a good idea. Warning Apple, he may impose a 25% tariff on manufacturing outside the US. What these companies are going to do, and I'm just going to think this through, they're going to state that they're going to open up all these plants here, spend all this money here, and then they're going to see what happens in the midterms, and then they're going to see what happens in 4 years. That's where my head is with this. I don't know exactly where he expects Apple to put these plants. If he's going to try to open them here, you can't open them by a Tuesday. So we need more of a game plan here. But I will say this, of all the companies that he keeps going after, Apple is in his crosshairs. And I'm not entirely sure why so much, but we're seeing more and more of that right now. When you see some of these other car companies like Volvo's 50% tariff would limit the ability of Volvo cars to sell its Belgium-made EX30 electric vehicle in the United States. This should be a positive in regards to Tesla. Now, I don't own an EV, but I would think that less competition in that space is going to make that better for something like a Tesla. But Tesla sold off because I think they're expecting retaliatory some conflict there. I think this is a developing story. I don't think this is the beginning of it. And remember, this pause was 90 days. We're 45 days into it. And where this leads me to is to more instability. So, and I'll explain where I'm going with this. This, to me, was the most critical thing that I don't think people are paying attention to. This X, U.S. Steel, the fact that we're referring to it, and we're going to dive into some detail. Is it a partnership? Is it a merger? Is the current administration allowing our steel in the U.S., I'm in the U.S., to just be acquired by Japan, and now they're going to be in control of these jobs? Because we just went through this whole thing with tariffs being American manufacturing. And I think that this could really derail a lot because right now he has a tremendous amount of support for tariffs. Maybe not on Wall Street, but on Main Street, the tariffs, American jobs. How are you going to coincide all of that with allowing Japan to control this company? And they're using this language. We're going to dive into it here. And I'm really interested in your comments on this. But how are we going to allow them to control? Because if they, quote, merge and, quote, not a partnership, how are you going to control that? You can't. You can't write into law like things like that. So let's take a look at this. But this is the thing that I don't think people are fully understanding the amount of risk to what he's trying to do here. The most interesting things in developments on Friday to me was Trump to allow Nippon U.S. Steel deal to move forward. Japanese company pitched the new American plant and billions of dollars in additional investment to win support from Washington. To me, it's really the language of this. There seems to be just this complete belief that this is a merger and it's going through. But before we get into some of the details, I just want to point out when this article is. 8:48 p.m. Eastern Standard Time. Now, when we get into the parts of this article, I don't see the word merger. And it's $55 a share for cash, and the stock bid up highly. And I'm going to just have a disclosure in going into this. I shorted it, I pulled money out of it, and I bought puts with the money. I'll do this sometime if I want to bet against something that people think is a really good, like it's like, oh, it's a no-brainer. It's definitely going to get bought at 55 because that was where the deal was. What's so fascinating to me is they're putting about $1 of risk in this deal, which seems insane to me. Even if I'm wrong, I don't think that this deal is at a 98 or 97% done and that it's going to get done immediately. So I'm surprised that the spread went that tight, but we'll get to that in a second. I've got asked a lot to start showing examples of when I talk about reflexivity, and this is a really good one. And I just thought it was so interesting under what he described as a partnership. It's not a partnership. You either buy the company or you don't buy the company. Key aspects of the deal still to be ironed out. That's not a merger. But Trump announcement signaled the Tokyo-based company could eventually enter the American steel market and make big investments in vision when it reached a $14.1 billion deal to take over U.S. Steel. Defined the agreement as a partnership, spurring some confusion to the companies on Friday afternoon. Now, I want to be real clear about this article because it's extremely concise, but it's very well written. And the devil's in the details. Spurring some confusion at the companies on Friday, according to people involved in the deal talks. So the people that are actually involved in the talks are like, what's a partnership? Does the merger go through, or is this some kind of partnership? Both Nippon and U.S. Steel were seeking more guidance from the administration about how much ownership Nippon could ultimately gain. So the idea that, hey, this merger is going to go through and that's great, and it's done. The partnership will add the two companies will result in 17,000 jobs, which is excessive. Adds $14 billion in the U.S. economy. Okay, the bulk investment will occur in the next 14 months. For many years, the name U.S. Steel was synonymous with greatness, and now it will be again. Well, if Nippon Steel is taking over the company, then how does the name U.S. Steel still stay around? Okay, so you keep it there. And the Post said adding the company's headquarters is going to be Pittsburgh. Trump plans to visit U.S. Steel operations for May 30th. Now, there's a couple things about this. At the time of recording this, these two headlines dropped, and they dropped this morning. And so I just clipped them out of our community because when I see things in our community, I'll just I have all these news services in there. I'll just clip them and post it if I think it's really important. Language to me with this kind of stuff is super important through mergers and acquisitions because I've been around it for a while. So to expand through Nippon Steel collaboration, that's not a merger. U.S. Steel to stay American. Neither of those lines is a merger. If Nippon Steel takes you over in a merger, it's a merger. They own the company. That's what they're buying. They're buying something. To expand through Nippon Steel collaboration. Collaboration is not a merger. Semantics, the other thing they could be doing here, if we're very honest about this, is optics. Because you have an administration that is out there right now saying American jobs, American workers, and now you're giving a foreign nation the ability to control the union in Pittsburgh. And let's be real, you can promise anything you want, but once they own the company, they can do whatever the heck they want. They can say things are slowing down, we have to lay off, we have to cut jobs down. I don't want to spend an inordinate amount of time on that piece of it, but anyone that's been around any union knows the games that they can play. And I think that this is really dangerous for him, meaning the current administration. I'm going to tell you why. And I want to state why I'm spending so much time on this. He has an agenda, and the agenda is America first, American manufacturing. He's got to tie this whole thing together, and it's got to be tied together in such a way that it does not look like he's selling out union jobs. I don't know how you're going to pull this off, so I'll just say it that way. I don't know how he's pulling this off. But maybe he is going to pull it off in such a way that it is a partnership, which is what I think it's going to be, versus a full-on merger. And that's why I think that the risk really, or the money that could be made, is to the downside. I don't see why 55 a share is going to do it unless they're going to pay more for the company. So there's a couple different things that could happen here, and I might as well start with them. Number one, the price might be higher than $55. In other words, you're not going to inject $14 billion, which we're going to get to, and not get something more from it, right? So what are they going to get from it on that $14 billion? I'm wondering if they're just going to get the lion's share of the profits. That's what I'm thinking. So why would Nippon pay more for the deal? Maybe to get it done, but that just puts cash in shareholders' pockets, right? It's just going to transfer down. So then the question is, well, why would Nippon inject more? Well, would you inject more into the company if you're going to get more of the profit? Well, yeah, you would do that. Or if you can increase capacity here and know that you now have contracts that you never had before. yeah, then you would inject capital into that. What I keep going back to is this word, partnership. And I think it's super important. You cannot run on this policy of America first, American jobs, and sell your steel, US steel, to a foreign nation, no matter whether it's a friendly foreign nation or not. And you certainly can't say, oh, we're going to let them take control of when union hours are going to take place. Anyone that understands this understands the risk associated. And you may think that I'm spending too much time on this, but this jeopardizes his entire idea of American first with manufacturing. Because if this doesn't work, they're going to tear him apart. And it's going to affect midterms. It's going to affect a lot of what he does. And I don't see him doing that. So my sense of this is whether this gets done or not gets done, it's got to be done differently than we think it's being done, is where I'm going with. U.S. Steel remains headquarters in Pittsburgh under a planned partnership with Japan's Nippon Steel. Social media Friday. It wasn't clear the terms of the deal or who would control U.S. Steel under the arrangement. Neither company explained Friday how the partnership would be structured. This is from a paper in Pittsburgh. What's interesting is the companies don't know, as I just showed you 2 minutes ago. Or are they not telling anybody? Congress members, local and state lawmakers from Western Pennsylvania are posting their reactions on social media. I'm going to just show you a couple of them. And this is from the governor. And I think that it's pertinent to just kind of look at this stuff and say it. Since the day of the proposed transaction, Davis and I worked with the leaders of Nippon and U.S. and local. So they're taking credit. So something is going to happen, or else a politician would not take credit for it, right? If something was going to go poorly, they wouldn't take credit for it. If U.S. Steel was going to lose jobs over this or lose some form of autonomy, a governor's not taking credit for that. Throughout the entire process, I maintained that my priority was to keep and grow jobs here in Pennsylvania. This is really key. And to me, how can you know that they're going to grow and keep jobs here and get the largest investment we possibly could for our Commonwealth? As I expressed to Trump, we discussed this transaction in recent days. Okay, so he's working with Shapiro, obviously Democrat, over there to get this done. Now that the president, who has sole discretion, see how they're throwing it back on Trump, who has sole discretion making authority on, and this is the organization that determines whether or not this deal is a threat to the military or national security, expressed his support for the deal. We have the opportunity to deliver historic investments, ensure the future of America's steelmaking continues to run through the Mon Valley. With the headquarters of U.S. Steel remaining in Pittsburgh and have our workers right here in Pennsylvania continue leading the world in their skills and innovation. My sense of the way that this reads is that that's not what a merger sounds like. This is exactly what I was saying about this as well. For the year and a half, the goal, and this is from a congressman out there in the district, 17th district, protect union and steelworker jobs. How are you going to do that if it's a merger? You can't. You can't force a company. You can write it into the contract, but you can't force a company to do this. And that's really important for people to get. I think they got it at this point. The devil's in the details about Trump's announcement for the future of steel. But I do know one thing. Thank goodness guys like me didn't fold and weekly because Nippon's initial offer, because we didn't blink, and the report, $14 billion on the table, is 10 times better. So the injection is 10 times better. We'll keep holding Nippon and U.S. feet to the fire. We need ironclad agreements about jobs. And this is exactly what I'm saying. How are you going to get an ironclad agreement on this? You can't once it's a merger. The steelworkers' jobs and contractual rights, Pittsburgh headquarters and investments, Western PA. Alongside the labor industry, I will keep working the White House, the governor, and federal locals to make sure our region emerges stronger than ever. I'm interested in your comments because maybe I'm too close to this because I grew up in an area that had huge union area. I grew up in an area where like Boeing was like really, really big. So I watched how this stuff would affect like the guy out there trying to earn a wage to pay for his family. And maybe I'm too close to it. But I see the move, but let's talk about it from the stock perspective. So you see the move, closed at 52, and then you watch this after hours and you watch. And I am always interested in your comments because like maybe I'm missing. And so 55 is the target, right? That's where the deal is going to get done. Unless they're going to pay more, which makes zero sense. So you have the move down and then the move up. My initial reaction to this, quite frankly, is the move down was the right move. And I could be wrong here. But this is a great example of reflexivity, which I talk about a lot, where everybody expects an outcome and has an expectation of that outcome, and then the outcome is completely different. I would argue that there's probably, if I had to weight it, 65 to 75% that this is actually a merger, and they are using the term partnership so that this does not go in his face. But if you're going to, and there is no other way for me to say this, and it's not really political, but if you're going to allow a foreign nation to control what the union is doing in the United States, that's not American first with manufacturing jobs. And I can't imagine that after how politically savvy this guy has become, that he's going to go to a rally in May 30th and show good news, I sold this company to Japan. And so that's where my head is with it. To me, just so you understand where I am right now, and so you understand my bias as I speak, is that I'm short here. And I look at my risk, and I'm through puts, candidly, to limit my risk. But I look at this and go, what am I going to lose, $1? And then how long is the merger going to take? It's going to take 6 months, and it's going to be opposed. You're going to see other lawmakers come out like Fetterman and these guys. They're going to oppose it if it's just an outright merger. I don't have any doubt of that whatsoever. And this is going to be a sticking point. So I would watch this really closely this week. I haven't done a deep dive like this in a while on an individual name on this. I think I might start doing them again. Watch this week. It's going to be massive, and it can actually shift the way that his position with America first and American manufacturing jobs is going to be taken seriously. And that's a real thing, because that's what we've been doing, quote, with the tariffs to bring jobs back to America. So why would we put a foreign country in charge of that? Just my opinion, and I think it's worth playing. And quite frankly, I think if you're long this, I have to kind of ask, like, why? Like, what after this, what are you going to make, $1? Or do you think that the deal is going to get done higher? Like, what is the purpose to being long this? You could make more, because think about these deals, right? And this is why I think everyone got overexcited and maybe the shorts covered. It's going to take 6 months. Like, what are you going to make? 2.5% over 6 months? Go buy a treasury. It doesn't make any sense. Again, I really do. I appreciate your comments on this. To me, it's one of those things that can unravel everything that he thinks he's trying to do here. And if we start to see that, it becomes harder for people to put money to work. Meaning because, well, I thought this was the theme. So is this the theme or is that the theme? And then it adds levels of instability. Speaking of instability, I think you're going to get a real clear indication on what's going on here with tech this week. I think if we take a look at something along the lines of what's going on with NVIDIA, Wednesday, you're coming in Tuesday hot. Stocks down. You have 1 day, 2 days of trading before people are going to put on their bets on what's going to happen here. Last quarter was great. The guidance was bad and margins were off. We already know there's a write down on the H20 because tariff on again, off again, what names you're allowed to buy, what names you're not allowed to buy, which chips China can buy, if it's Tuesday or Wednesday. Like, it's absolutely insane. But we do know that Saudi Arabia is now able to buy whatever the heck they want. We do know that UAE has been relaxed. To think that we're not going to see some level of guidance up on that, I think is delusional. And maybe I'm off, but I would think that you're going to see something like that. You've been in a major trading range. If we take a look at this from May 20th on down to this level, which is roughly that 91 level, you've been basing. You have this huge base here. And to me, it looks like a double bottom. The undercut here, and it looks like you could rip on this. If I do something as simplistic as the RSI, it's starting to flip back over 50 ahead of this. And I would want to take a look at this and watch this. I do want to go through two of the things that I said I would do in the video that I do think are important. But if I look at like the AVGO, I do want to go through the McClellan summation here because I do think that's important. I really do. And I think you just need to say it real quick. But if I look at the AVGO, I mean, this looks fantastic. And you're not breaking and you're not breaking down. What I'm having issue with is we're losing leaders. MSTR was a leader. We rode this thing for 85 points. And then we got out of it actually this day, and then it cracked. And you could see from these negative divergences, as I like to say, you don't have to believe in them, but they believe in you. So then the question becomes, where are we going with this? And then we start saying, well, industrials are up, but is that it for the move for now? Are they going to start seeing fear again? Utilities have slowed down, and we are seeing one common theme that we should really be paying attention to. I don't think it's unrealistic to think that uranium is going to be like the theme going forward. And I'm going to do a video on it this week coming in, so make sure you subscribe to the channel, click all notifications. I don't know that you have to chase, but it's very clear to me between what what they're saying, Germany's saying, that this is where we're going. I do want to wrap it up, and I do want to leave this. So I look at the McClellan summation a lot, and I look at it from these crosses here and to when I'm over the zero line. Right now, I have a zero line cross right here. just be aware of this. And what we don't want to see here is this break the zero line. I'll get into this more as the week goes on, but you really want to pay very close attention to this. You don't want this crossing, which it's doing already, and you don't want this breaking zero. That is it.